In this video, we're going to cover 3 of the potential tax mistakes people can make in retirement, the kind that could potentially cost you way more than you think over time. Now, if you've been saving for the last 30 or 40 years, you followed the rules, and you're either retired or getting close, this is exactly when taxes can start working against you, unless you know how to plan around them. Now, these are not loopholes or gimmicks, just real practical strategies that most people aren't told when they leave the workforce. And by the end, you're going to understand how to avoid some of the most common traps that can shrink your retirement income faster than expected, especially the last one, which surprises even the most prepared folks. So make sure you watch the entire video. Let's get into it. So potential mistake number 1, we call tax harvesting. You may ask, what is tax harvesting? I'm about to show you a hypothetical example. Simply put, this is one of the most overlooked strategies, and it can make a big difference. If your income is low enough in retirement, especially in those early years, before Social Security or required minimum distributions kick in, you may be able to sell investments that have grown substantially in value and pay 0% in capital gains. That's right, I said it. Potentially pay 0% taxes on capital gains. Now, most people think that selling investments that have gone up in value means that if you sell them, you're going to owe money in tax. And usually that's the truth. But in years where your taxable income is lower, the tax code actually gives you a chance to sell those investments, keep the gains, and not pay anything in federal taxes, as long as you stay under certain limits. Even better, it resets the clock. So if those investments go up again in value, you're only going to pay tax on the gains, not the original principal. Here's how this looks. So in this hypothetical example, the scenario we're going to show you is with Tim and Tammy Sample. They're both 60 years old in retirement. We're using tax year 2025, and the tax rules that we're going to work with are the newly passed legislation of the One Big Beautiful Bill Act. All right. Now, they want $120,000 in retirement. They have around $2 million. Okay. They have $1 million in IRAs and 401ks that they don't have to touch right now, but they also have $1 million in a joint non-qualified account. $250,000 was their original cost basis, and that account has grown to $1 million. So there's $750,000 in capital gains. So what they want to know is how they can pay the least amount of taxes when they retire, and they need $120,000 a year or $10,000 a month. So here's what we're going to do. You see, we're going to take out about $90,000 out of their long-term capital gains, out of their joint after-tax account. We're going to supplement that income with $31,500 from their IRAs. In normal circumstances, if you pull out $90,000 from your after-tax account, depending on your tax bracket, you're going to pay anywhere between 15 and 20% capital gains. However, in certain circumstances, especially when you retire and your income is low, you have an opportunity to pull out capital gains and not pay any tax. And we're going to show you what that looks like, any federal tax. So here is their tax map. So what you're going to see in here, okay, that $121,500, we're paying 0 in taxes, okay? 0 in taxes, right? You can see it right here. They've got $31,000 in income from their IRAs, $31,500, $90,000 in capital gains. So that's about $121,500 in total income, right? They've got their standard deduction, and they're paying, and you see it right here, 0% on this $90,000. So here's what you need to understand and know, and we can get into this in detail, is that if you have a lot of after-tax money that's labeled joint with rights or survivorship, or if it's an individual account or it's a trust-owned account, these are non-retirement accounts. They actually have more favorable tax brackets than your IRAs and 401ks. And if you have enough money there and you want to supplement that with IRAs under certain income limits, like example right here, we're at the limit, because any more money, they're going to start paying tax. We're able to pull out $121,500 for these individuals, and they're not paying any federal tax. So you got to make sure that you're working with the right team, the right advisor that understands tax planning or tax mitigation planning, because you may be paying too much in taxes on your distributions currently. Or if you do not have a income plan where that income plan is focused on taxes, you may be unnecessarily paying too much in taxes to the government. And there are ways where you can pull money out and be in a zero tax bracket. The RMD Tax Torpedo. Now, this one catches a lot of people off guard because it's generally not well explained. As your income goes up in retirement, more of your Social Security can be taxed depending on where you pull your income. And at a certain point, up to 85% of your benefits can be included as taxable income. And that can reduce what you actually keep each month. So let's make sure you understand this. Social Security can be taxed as much as 85% of it if you're pulling too much income from different sources. Why we call this the RMD Tax Torpedo? Because eventually you do not have the ability to delay distributions from your IRAs and 401ks, either when you're 73 or 75, depending on your birth year. And if you're not careful, not aware, when you're forced to take your RMDs, it can bring your tax rate on your Social Security up to 85%, which means now you're receiving less out of that bucket. But the good news is with the right planning, you can often control how much your income shows up in retirement, especially if you're not taking RMDs yet. And by being intentional about which accounts you draw from and when, you may be able to lower the amount of your Social Security that gets taxed. Let me show you how future RMDs in this next example. Let me show you how, if you're not careful, and this is all dependent upon your situation, how much you have in your investment accounts and IRAs. Let me show you where you need to be careful and understand where taxes on your Social Security could be a big concern. So now what we have again is Tim and Tammy sample, hypothetical clients, right? You can see they're about 66 years old, fully retired. Again, we're using tax year 2025. And again, tax rules, we're using the One Big Beautiful Bill Act that again was recently passed this year. They need and want about $100,000 in retirement. They're triggering Social Security because they believe that it's their full retirement age. So they're going to get about $80,000 from Social Security. And then to supplement, they're going to take about $20,000 in IRA distributions to get their income. Okay, so you can see in this example, that $100,000, they pay zero in federal tax. You might ask yourself, well, how is that even possible? Well, I'm going to show you. If you take Social Security, right, and you blend those with other sources of income, depending upon those other sources of income and how much, you can be in a low, or in this case, a zero tax bracket. So you can see here, their provisional income is about $60,000. Provisional income is your half of your Social Security plus any other IRA income. Plus there's things like non-taxable interest and things like that, but they don't have any of that. So it's $40,000, which is half of Social Security, plus their IRA distributions. That's $60,000 of provisional income. Their taxable Social Security is $19,600. Because that falls under the Social Security thresholds as far as being taxed, in this circumstance, they're paying zero federal tax. So they also have $1.1 million in IRAs and 401ks that they don't need to pull from outside of the $20,000. And their RMD age is in about 7 years, which is 73. So let's assume in this next example that that $1.1 million doubles, right, over the next 7 years. So now what we're going to do is we're going to compare a side-by-side comparison, visualizing in 7 years, Tim and Tammy now have to take their required minimum distribution, right? Their $1.1 million has now doubled to a little bit over $2 million. Their RMD would be about $90,000, okay? So now what you're going to see in their customized tax map, you're going to see now how that RMD just explodes their tax bracket. So, right, the green dot, again, is them taking $80,000 in Social Security, $20,000 IRAs, no tax. But now, 7 years later, they're forced to take their RMDs. Now, RMDs are about $90,000. Look how it jumps them all the way up in the tax bracket. Now, their marginal tax rate is now 24.65%. That extra $70,000, which was their RMD, the effective tax on that was 21%. Now they're forced. And also what that does is I'm going to show you here, the side-by-side comparison, right? We'll call this their base case. This is when they retired, $20,000 in IRA income. $80,000 in Social Security. This next scenario was the same Social Security, but forced RMDs. And what you're going to notice now is that this is pulling in the maximum Social Security tax. Now, $68,000 of their Social Security benefit is now subject to taxes because they have so much other IRA income. The way the tax rules work, based upon your IRA income, you could potentially pay up to 85% in Social Security tax. So now they're paying taxes on that Social Security benefit. That means they're receiving less. And their total tax, what before was zero, now they're paying about $14,000 in federal tax. So here's the learning lesson. If you are not proactively looking to reduce your potential RMDs once you retire, then there may be a situation where you get caught off guard and those RMDs, which we call the tax torpedo, absolutely blow up your tax bracket and you now pay more taxes on things like Social Security. So the solution is to work with a team, with an advisor that focuses on proactive tax planning so that we can reduce those RMDs and hopefully keep the amount of taxes that you would pay on Social Security back to zero or keep them much lower than the maximum of 85%. This is something you have to look forward at, and it's something that you definitely need advice and help with from our perspective. And finally, the potential biggest mistake that one can make, which is number 3, this is one of the most powerful and misunderstood tax planning tools, Roth conversions. There are ways to do it correctly, and there are ways to do it incorrectly. And basically, a Roth conversion means moving money from a traditional IRA into a Roth IRA, paying tax on the seed, the amount that goes in to the traditional IRA from the conversion, so that the harvest, the growth, is tax-free. Now, you pay taxes on the amount you convert now, but once it's in the Roth, it grows tax-free. And qualified withdrawals are tax-free too. Of course, as long as you hold that for at least 5 years. But here's the thing that matters, the timing of it all. If you convert too little each year, you can still end up in a higher tax bracket. If the growth of your IRAs outpaces the amount that you convert every year, you're really not moving the needle, especially once required minimum distributions and Social Security kick in. Now, convert too much, and you might push yourself into a higher tax bracket too soon and pay more tax than you actually needed to. Plus, if you consider if you convert too much, and let's say markets are volatile, imagine paying a big tax bill on a Roth conversion and 20 or 30% of that money goes down to the market. The other thing you can consider, depending upon the age that you're at, if you're already taking Medicare, if you do convert too much, your Medicare premiums can go up. There are thresholds under the IRMA rules. The key is to finding the sweet spot, converting just the right amount each year to lower your lifetime tax bill without creating unnecessary tax spikes today or in the future. Let me show you a hypothetical example in our planning software so you can see how this could potentially help you, or in this case, this potential hypothetical example. So here we have again our potential clients, Tim and Tammy sample. Here is their situation. They've got about $2.7 million in total assets. Tammy has $1 million in a pre-tax IRA. Tim has $750,000 in a pre-tax IRA. And they have an after-tax account of about $700,000, a joint account, and they have $250,000 in cash. Let's go over some of their facts. They're both 60 years old. They want to retire now. Okay, their financial priorities, they want to minimize taxes, they want to help with retirement planning, some investment management, and they want to make sure they don't run out of money. Their goals are they want about $100,000 in retirement, and they have Social Security, which we're going to plan on taking at age 67, which is their full retirement, and they have a pension of about $30,000. So now what we want to do, and I think this is very valuable, is we want to show them that if they just take out Social Security, their pension, distributions out of their retirement accounts, what is their lifetime tax bill going to be in retirement? So here's what you're going to see. We'll go through all these numbers. So here's the bars. They're going to be in a very low tax environment up until right about when they take their Social Security. Then their taxes are going to jump up a little bit. But then what you're going to notice is that their tax bill just spikes This is when their RMDs are due, age 75, right? Again, we've made reference to this in many of our episodes, the tax torpedo. So if they don't do any tax planning from now until then when they pass away, what you're going to see here is their cumulative lifetime taxes, which is about $1.4 million. And then you can see they have the potential to leave about $5.6 million behind. Now, some of you may be asking, okay, what are some of the assumptions that we're using? We're using a 3% inflation rate, and we're giving their investments about a 6% rate of return. Okay, now the goal is, like we talked about, the timing of doing some Roth conversions. What is the sweet spot to see if we can do two things? This is the goal. Potentially lower your lifetime taxes. Obviously, people want to pay less to the IRS and keep more of their wealth. But by doing that, we should be able to potentially, not every single case, increase their total portfolio assets through what we call tax alpha. When you have more assets growing tax-free, you have less assets that are subject to RMDs. And remember, tax rules generally change over time. I know with the one big beautiful bill, they made the tax cuts permanent. At least for the next 3 years, we know what the tax rates are going to be. And when a new administration comes in, you never know what changes can be made. So you never want to say anything is permanent. So now let's just apply some basic advanced tax plan. So now what you're going to see, essentially what this did, and I'll explain the charts and the colors, this has the potential to reduce their lifetime taxes at about $750,000. So that is a lot of money, right? And I think everyone looks in here and goes, wow, this is extremely valuable. But where I think the bigger value is here is that it has the potential to increase your overall assets at about $3.2 million. So in this example, we were able to accomplish two things: potentially lower their lifetime tax bill to the IRS, and then have more money in their portfolio, again, from that tax alpha, more money growing tax-free for longer, and that money's not subject to RMDs. But there's no free lunch, right? We like to say with taxes, it's pay me now or pay me later. Since the one big beautiful bill did extend the Tax Cuts and Job Act at least 3 more years, we're aggressive in the early years, right? You can see, so the red is us paying more taxes today, right? More taxes today. So kind of ripping off that Band-Aid. So here's kind of the pain. The pain is sharp early, because the idea here is that if we don't do anything, they're going to be stuck in a higher tax bracket once they take their RMDs. So since they're 60 and they have 15 years, let's try to reduce or potentially eliminate RMD. So in the back half of their retirement, they're in a much better tax bracket. So you can see here, we're paying higher taxes here early, but in the back half, you can see they're paying a little amount of taxes. In fact, all these now gray bars, this is more tax-free wealth. So not every situation's the same, but if you're watching this, you're contemplating whether you want to retire early, you've got a lot of money in IRAs and 401ks, no one's ever showed you what tax planning can do as far as reduction in taxes and creating tax alpha. Looking at, again, the sweet spot, what is the perfect amount to convert with Roth IRAs to get the best outcome? You can see in this example, we were able to essentially almost get rid of any future RMD, and this had a huge impact on their overall portfolio. So definitely recommend sitting down with an expert that understands tax planning, can build out your scenario to show you if this is even possible. If you're curious about how we help people protect what matters most in their retirement, and you just want to see how our process works for you, give us a call or visit our website at www.bamadvisorygroup.com. You can schedule a 15-minute, no cost, no obligation, no pressure phone call with one of our advisors to get all of your questions answered, to understand your options, and for us to be able to provide you with more information and clarity. And if you're enjoying the show, don't forget to like and subscribe. Thanks again for watching. We'll see you all real soon.